Okay, let's look at this example that relates to the decision about whether to eliminate a product or a service or a division or department. So in these types of decision, what's important again is to determine what's relevant versus what is irrelevant. As in other problems we've done, irrelevant costs are the sunk costs, and they're typically your fixed costs. And the key on those is they will not change if the object is eliminated. In other words, they are going to remain the same. Relevant costs are the costs that are going to change as a result of the decision. So in terms of relevant costs, when it comes to deciding whether to keep or eliminate a product or a service or a department, i.e. a cost object, you want to look at what is the incremental profit, i.e. what's the incremental revenues minus the costs that that product or service or department provides. So if you look at this particular example for Lock, Stock, and Bagel, you have their income statements, and in looking at it, you would see that the operating income or loss, which is in parentheses, you can see that product A is losing $250, product B is losing $2,500. The thing that you have to be very careful about, though, is the operating income isn't really what you should use to analyze whether to eliminate or not. What you need to look at are only the things that will change as a result of eliminating. And here I want you to focus on fixed costs. All of these fixed costs have been allocated to these products. Unless it is said otherwise in the problem, you basically have to assume they're fixed. In other words, more information would have to be given about what would not or what would, go away if the product or service or department were eliminated. All of these are allocated, and it says in this problem that the total fixed costs will remain the same even if a product is dropped. So this would be like, for instance, we did those problems where we were looking at the different departments in the business school, where if all of the costs relate to, say, the dean's office, and they're not going to fire the dean if you get rid of an say the accounting department, the key being that those costs are there regardless. So if you keep that in mind, you've got to be very careful in not looking at these costs. These are irrelevant. So if you work your way up the income statement, what is relevant is your contribution margin. So what you can see here is that the sales revenue would go away, so that is relevant. The variable cost would go away, so that is relevant, excuse me. So the contribution margin is what you will be looking at to determine whether to keep or eliminate a cost object. So if you look at the contribution margin for product A, you can see that although it wasn't profitable after you allocated the fixed cost, it is helping to cover fixed cost. So product A is not one you want to eliminate. That's not the case, however, with product B. And with product B, you can see here that it's not even covering its variable costs. So in that case, you would want to eliminate product B. So again, to sum it up, to decide whether to eliminate or not, you want to look at only the relevant costs. Okay, the fixed costs are irrelevant, they won't go away. The end result, product B should be eliminated since it doesn't contribute at all. It's losing 500 every time you or as you keep that product. Product A is another story. It should not be eliminated, even though you may think so at first. And that again is because product A contributes $3,000 to covering fixed costs. If you get rid of product A, you're going to lose that $3,000. You're not going to lose $250. You're going to lose $3,000. And again, it's because it's helping to cover fixed costs. So beware when faced again with a problem where you have to decide whether to keep or eliminate. Only look at what's relevant, and typically fixed costs are irrelevant unless otherwise stated.